It's not quite Tom Cruise dancing in his underpants, but investing in 2016 is still very much a risky business. Every day we're hit with ever more alarming headlines and news bulletins. It's enough to overwhelm even the most stoic investor. To help make sense of it all and explain exactly what we mean by a risky investment, I'm joined by Blueprint Wealth financial planner Brad Martin. Brad, what do we mean by risk?
Ben, risk is the chance of you losing your money. So you have to ask yourself, how much risk are you willing to take to get the investment that you're after?
And so what is a risky investment in 2016? 5%, 10%, 20%?
Anything higher than about 6 or 7, you're taking a lot of risk to achieve that.
What's the safest investment in the world?
The safest investment is money in the bank, Ben. You're going to get 2.5%, 3%.
Money in the bank's giving you maybe 3%, but most superannuation accounts will be returning far more than that. Explain how a balanced fund works versus a conservative fund.
On average, Ben, a balanced and conservative fund will outperform cash. So a conservative fund has a lot of money in safe investments with a few in shares. Over the last 20 years, they've averaged about 6 to 7%. A balanced fund increases the risk by putting more money in shares and property. They've got about 70% in those assets. They've achieved about 8% over the past 20 years.
So what implications does it have for the size of your nest egg over, say, 2 decades?
The difference between a conservative and a balanced fund can be 1 to 1.5% per year. Over those 2 decades, it can mean a difference of $114,000 on a $100,000 investment.
Our risk profile does change over time. You can be very aggressive when you're in your 20s, but if you're nearing those golden years, you don't want to take as much risk because you've built that nest egg up. You don't want to see it go down.
That's right, Ben. In your 20s, you can be more aggressive and invest in shares and property as you go along. As you get older and closer to retirement, closer to needing your money, your appetite for risk generally decreases. You've got a large balance at this point, and protecting it is sometimes more important than the big returns that you're chasing in your early years.
Thanks, Brad. Risky business, it's no laughing matter. And to find out more information about how your superannuation works, make sure you read Securing Your Future, the free magazine in the West Australian, produced as part of Financial Planning Week 2016.